The RBA just raised interest rates for the 12th time since the COVID lows, raising them by 25 basis points to a cash rate of 4.1%. But that's not the only troubling news for the Australian housing market, because the mortgage cliff is going to hit at the same time as surging interest rates. And this is going to create the perfect storm for the Australian housing market, which has been so resilient up till now, but might just be on the verge of collapsing. I'm Biko Constantine, and that's what we're going to talk about today. If you've ever been stung by a bee before, like this fella, why don't you give this video a like? And if you've ever been stung by love, consider subscribing to my channel. It's totally free, and Greeks love free things. Did you know that Greeks are so tight, if you stick a lump of coal up their bums, you get a diamond? Now let's have a look at this interest rate rise. I'm just going to go through a few sections from the RBA governor's statement. So the board increased the cash rate by 25 basis points to 4.1%. It said that inflation in Australia has passed its peak, but at 7% is still too high and will be some time before it's back in its target range, which is between 2 to 3%. This further increase is to provide greater confidence that inflation will return to target in a reasonable time frame. Now these next few sentences I've just picked out from different areas in the statement. Recent data indicate that the upside risks to the inflation outlook have increased, and the board has responded to this. So after the pause in April, upside risks to inflation seem to have now increased and got the RBA scared. Housing prices are rising again, and some households have substantial savings buffers, although others are experiencing a painful squeeze on their finances. Now this is very interesting, as we've all looked on and wondered, how can house prices start rising again when we've seen some of the fastest interest rate hikes in our lifetimes? Now this wouldn't have gone unnoticed to the RBA and could have factored in their decision to raise rates. Now they've also correctly pointed out the great divide that's currently happening in Australia. Those who had smaller mortgages were basically handed free cash when interest rates were reduced to zero, and they were able to save significant amounts of money that never would have happened in normal circumstances. So even now that interest rates have surged, because of their low mortgage rates, it hasn't affected them very much. Yet on the other hand, we have those more recent buyers with larger mortgages who are now getting absolutely squeezed. And then we have the boomers who've paid off all their mortgages, have seen their properties rise by about 30 or 40% just in 2 years, and have piles of cash that are now making significant income due to the rising interest rates. Boomers win again. Here's their concluding statement. Some further tightening of monetary policy may be required, which means potentially more interest rate rises, and the board remains resolute on reducing inflation and will do what is necessary to achieve it. So what does this actually mean? Well, it means that all the so-called experts keep getting interest rate predictions wrong. Initially, no one even thought inflation would be a problem. Then no one expected interest rates would go above a 3% cash rate, and now we're sitting at 4.1% with more probability of further rate hikes. But when you consider that New Zealand has a current cash rate of 5.5%, Australia's not actually doing so bad. And guess what? Their house prices have tanked way further than Australia. But there's an Aussie storm brewing. So interest rates in Australia have now risen 400 basis points in only 14 months. As you can see by the red line in this chart, this has been the fastest tightening cycle in the last 30 years. The fixed rate mortgage cliff is here. You see, there's around 900,000 mortgages that were set up with ultra low fixed rates around 2% during COVID. But most of those mortgages are now expiring, which means they have to be refinanced at the current variable rate or a much higher fixed rate. And with the latest interest rate rise, the current rate is now over 6%. So many will have gone from around 2% all the way up to 6%, which is an unbelievable increase to the monthly expense that these mortgage owners will have to incur. Now, the majority of these fixed rate loans are actually expiring from now until the end of 2020. 2023. As you can see from this graph, the quarter ending June 2023 has 17% expiring. The next quarter up until September has 15% expiring, and the quarter up until December has 11% expiring. So this second half of 2023 is going to see the largest number of fixed rate mortgages expiring. Now, many people in this situation might have some savings buffers, so they'll be okay, but there'll be a number of people who loan the maximum that they were able to at ultra low interest rates, who never expected interest rates to rise this fast this quick, and may not be able to service the new adjusted loan above 6% interest rate. So this will most likely result in an increase in distress selling, because those who overextend themselves will be forced to sell, but there might be others who may be able to service the loan at the higher rates, but choose not to and choose to sell because they may not want the stress of having such a big loan with such high interest rates. So I expect to see a bit of both, and while house prices are currently still relatively high, some might take advantage of that and then try to downsize to a cheaper house. So at the current interest rates, a mortgage of $1 million will now need to pay an additional $2,000 per month or $24,000 per year, which is absolutely staggering. But you know the real sad thing? A $1 million mortgage or higher is pretty much normal in places like Sydney. And that's because the current median house price in Sydney is now over 1.2 million. But that's only the median, which means there's a massive amount of houses of all shapes and sizes above that level. Can you imagine a recent home buyer, due to COVID policies, which created massive speculation and artificially inflated house prices, had such a fear of missing out that they borrowed all that they could at ultra cheap levels because they were worried the housing market was getting away from them and they might never have a chance to own a home. Now, many people might blame those home buyers and said they should have done their due diligence and not borrowed to the hilt, which I do understand, but I've never seen more hysteria over housing in my lifetime, and I really do feel bad for recent borrowers. Just say they borrowed their max at around 2% interest rates. Banks only use a 3% buffer to assess their ability to pay the mortgage. So going from 2 and adding the 3% buffer, banks have only assessed those borrowers at around 5%. So now with interest rates above 6%, some borrowers are now above the bank's serviceability levels. And that means they're in deep doo-doo. Alright, so we've got some of the catalysts for a perfect storm, but will it be enough to end the recent rebound in Australian property prices? Here we can see how the clearance rates recently have been extremely strong, with all major cities in the 70%. And as you can see with this light purple, these were the clearance rates a year ago, and all except Adelaide were much lower. Here we can see how Australian house prices fell after interest rates first started rising, but since early this year they've started to strengthen, with this blue line showing the 5-city aggregate. But if you look at Sydney, they did fall the most, but they've also seen the fastest uptick over the last few months. What's been the cause of this strength? Many believe it's due to supply and demand constraints, with less than average houses for sale on the market and increased demand due to surging population, renters facing a crisis and being desperate to try and get out of the rental market, and also investors trying to outperform inflation. So we've got this crazy dynamic at the moment where we had mass speculation until the RBA started raising rates, but now some of that crazy demand's coming back and fear of missing out and all that. Who would have thought? You can't kill the Australian housing market, or can you? Someone who feels that this recent strength in the housing market is like a false dawn is Managing Director of SQM Research Lewis Christopher, who states that the probabilities of a double dip downturn in the Australian housing market are now higher than 60%. Christopher expects distressed activity to start rising in the second half of this year, 2023, and distressed selling will be amplified if unemployment levels start to rise. So Christopher states to be prepared for a new round of house price falls in the second half of the year, and he expects that the spring selling season will be a tough one for sellers. Christopher Joy from Coolabah Capital is also expecting further house price declines, and one of his major reasons is the loss of borrowing power due to the surge in interest interest rates. At a 4.1% cash rate, the median household has suffered a 29% reduction in purchasing power since the RBA first started raising rates. Now, what's going to happen if interest rates keep increasing from here? In some recent Freedom of Information disclosures, the RBA revealed some modeling which showed that it may need to boost its cash rate to 4.8% to get inflation back to 2 to 3% by June 2025. Now, 4.8% cash rate is not high based on historical levels, but considering the crazy amount of debt Australians now have for property, it's actually bloody high. If the cash rate did reach 4.8%, it would mean that purchasing power has been eroded by 33%. And in dollar terms, a median household who previously could borrow $773,000 would then only be able to borrow $515,000. And guess what? Houses so far have fallen nowhere near those levels. So according to Joy, this recent bounce in house prices is just an anomaly, and property prices will recommence their slide downwards. One of the big possibilities that we haven't yet discussed is for Australia to fall into a recession. But even worse than that, we could end up seeing a global recession as the recent surge in interest rates start having a real material effect on businesses around the globe. And it's almost certain that unemployment levels will rise from here, but how far they'll rise is difficult to know at this stage. If we do fall into a recession and unemployment starts to rise quite sharply, then the RBA could pivot and start reducing interest rates. But will that cause the property market just to surge back up again? Potentially not, because a real recession combined with rising unemployment means that many people in Australia will be doing it very tough in a much larger measure than what we're currently seeing now. And that could end up resulting in further weakness for property prices. So when the RBA does pivot and start reducing interest rates again, it doesn't automatically mean that house prices will rise. There could actually be a prolonged period of weakness or flat prices, which is what I'm leaning towards due to the unwinding of all the ridiculous speculation we saw post-COVID. But this property market is extremely difficult to predict, and I don't think anyone really knows what will end up happening. Remember, no one expected interest rates to go up this high, but here we are. So will this latest interest rate, combined with the looming mortgage cliff, be the perfect storm that destroys the Australian housing market? I'm Pico Konstantinos.